Okay, let's just get right into it. The AI bubble. It's literally all anyone is talking about. Hype is everywhere, valuations are just soaring into the stratosphere, but are we standing on solid ground here, or are we teetering on the edge of a cliff? That is the big question we're going to dig into today. So what are we looking at? Is this a genuine, massive technological boom, or is it a classic financial bubble that's just waiting to pop? We're going to lay out the best arguments on both sides of this debate. And, just a quick heads up, this is an explainer of the arguments. It is definitely not financial advice. We're here to understand the landscape, not to tell you where to put your money. Okay? Let's go. All right, let's start with the optimistic take, the bull case. The argument here is pretty simple. We are not in a bubble, or at least not the kind of bubble you might be thinking of. See, a lot of people immediately compare this moment to the dot-com crash, but does that comparison really hold up? Well, if you look at who's actually funding this thing, you see a massive difference between then and now. The dot-com bubble, that was fueled by venture capitalists just throwing money at startups with, let's just say, shaky business plans. Remember pets.com? Yeah, they were burning through cash. But today's AI boom, it's a totally different story. It's being funded by these established tech giants. We're talking Microsoft, Google, Amazon, and they're reinvesting their own record profits. So you see, the foundation this time around, it's just completely different. We're talking about real money from companies that are already wildly profitable, not just speculative cash. This boom is being built on decades of infrastructure that already exists: cloud computing, powerful GPUs, massive data centers. And the players in the game, they're trillion-dollar giants who can absolutely afford to play the long game. And that brings us to another huge difference. Back in the late 90s, the internet was full of promise, for sure, but what did you actually do with it day to day? Its utility was pretty limited for most people. AI, on the other hand, is already here. It's already working. Millions of people are using it every single day for writing, for coding, for automating little bits of their jobs. It's providing tangible value right now. To wrap up the bull case, it really just comes down to this. A bubble, by definition, is hollow. It's all air. But with AI, it really feels like there's real substantial value being created. Yeah, the hype is insane, but that doesn't automatically mean the technology underneath is empty. It might just mean we're pointing towards something that actually matters. But of course, there's another side to the story. So now let's flip the coin and look at the bear case. This is the argument that this whole thing might just be a giant house of cards. For every optimistic argument, there's an equally compelling skeptical one. And we're going to start with a truly astonishing number. According to one recent study, 95% of companies that tried to integrate generative AI reported zero improvement in productivity. In fact, for some of them, things actually got worse. Think about that. For every one company that's seeing a positive return, 19 others are pretty much just lighting money on fire. And this leads to a really crucial distinction we have to make. Sure, an AI tool can be useful for writing an email or, making a funny picture of your cat, but does that automatically solve a huge business problem? Does that actually boost the bottom line? The bears argue, not so fast. Usefulness and profitability are two very different things. And right now, AI is delivering a whole lot more of the first one than the second. So let's talk about the economics happening behind the scenes, because it's kind of wild. Running these large language models is incredibly expensive. We're talking about a massive amount of computing power and electricity for every single prompt you type in. This means that nearly every time you ask ChatGPT a question, OpenAI is actually losing money. Even with their paid plans, they and most other AI companies are deep in the red. So, if they aren't profitable, where is all this money coming from? Well, this is where things start to look a little shaky. It has to do with a practice called round tripping. It's basically a way for companies to create an illusion of growth by passing the same money back and forth. It looks really impressive on a spreadsheet, but it can hide some serious problems underneath. Here's how it works. It's a simple loop. Step 1, a big tech company, let's say NVIDIA, invests billions in an AI startup like OpenAI. Step 2, OpenAI then takes that exact same money and uses it to buy computer chips from, you guessed it, NVIDIA. And finally, step 3, NVIDIA gets to report all that spending as pure new revenue. See? It looks like everyone's growing, but really it's just the same investment dollars going around in a circle, not new money from actual customers. And that right there is the core vulnerability of the bear case. It's the Achilles heel. This entire ecosystem isn't sustained by actual profits from people buying AI products. No, it's sustained by investment. And if that investment capital ever dries up, if investors suddenly stop believing they're going to get a return, the whole system could come crashing down. So let's just assume for a minute that the bears are right and we are in a bubble. The next logical question is, what makes it pop? And the answer might not be what you think. There's a really critical difference here. Sometimes a massive bubble pops and it's so big that it causes a recession, right? Like the 2008 housing crisis. But other times it's the reverse. A general recession starts first, and that's what pops the bubble. Nervous investors pull their money out of high-risk stuff, and based on the latest data, that second scenario looks like a very real threat for AI. I mean, just look at this data from JP Morgan. A tiny handful of companies, just 30 AI-related companies, now make up around 44% of the total value of the S&P 500. Let that sink in for a second. Almost half the stock market's value is tied up in a very small number of companies, all connected to the exact same technology. That is a huge concentration of risk. And this concentration might be hiding a really big weakness. In fact, some analysts are warning that if you took away all the AI-related spending, the US economy's growth in the first half of 2025 would have been just 0.1%, practically nothing. It's possible the AI boom is just masking a recession that's already happening everywhere else. So you can see how the dominoes could fall, right? A recession starts in the non-AI parts of the economy, which spooks investors. They get nervous and pull their capital out of those high-risk AI stocks. Suddenly, the investment funding that's been propping the whole thing up, it just dries up, and the market corrects probably very sharply. All right, we've heard the bull case, we've heard the bear case, but for a final verdict, we thought it would be fun to go straight to the source. We decided to ask an AI to weigh in on all this. So here's what we did. We fed an AI the entire script for this explainer, all the arguments for, all the arguments against, and we asked it one simple question. Are we in an AI bubble? And we asked it for just a one-word answer. After about 12 seconds of, well, thinking, I guess, it came back with its verdict. One word, probably. A concise, a little sobering, and maybe a fittingly uncertain conclusion from the machine itself. And you know, there's a fascinating irony in all of this. The very companies whose massive investments helped inflate this bubble in the first place, Microsoft, Google, Amazon, they're also the ones with the deep pockets and the massive infrastructure to be the sole survivors if and when it pops. But maybe a pop isn't the end of the world. Market corrections, they have a way of clearing out all the noise, all the hype, all the get-rich-quick schemes. They force an industry to get serious and focus on what provides real, sustainable value. The internet survived the dot-com crash, and it came out stronger. AI will almost certainly do the same. So maybe the most important question isn't if the bubble will pop, but what happens after? What does the AI landscape actually look like on the other side of this? Now that is the real question I think about.